Hello and welcome to this Thursday's morning market briefing. We've got lots to talk about, but firstly, Jerome Powell says the Federal Reserve's fight against inflation is not done, as well as that gold hits a new high as investors do seek a hedge against the stubborn inflation that we're seeing. We've got lots to talk about on the charts, also with lots to talk about on the economic calendar as well. But we'll come to that near the end, so make sure you stay around so you can see that. Before we get straight into it though, make sure to subscribe. But the first article to talk about is to do with Jerome Powell and the Federal Reserve, of course. Now, Jerome Powell has now stated that the Fed's fight against inflation is certainly not done, and this comes as he reiterated that the Fed needed more confidence that price pressures were easing before interest rate cuts were to be made. Now, obviously, this is a very interesting article, especially coming off the back of yesterday's market briefing, where we did kind of expect this kind of rhetoric in yesterday's speech. Now, of course, in yesterday's market briefing, we did note, of course, that basically the Fed was, in this position now where, whilst they were holding on to this idea of, committing themselves to 0.75 percentage points of rate cuts this year, on the other hand, investors were expecting actually less of a cut in interest rates than the Fed. So I believe investors were expecting around 0.68. It could be 0.63 percentage points of rate cuts this year, and we know that the Fed has also expected to cut interest rates 3 times, so that 0.75 percentage point figure is coming from 0.25 percentage point cuts this year, which is what the Fed expected starting off the year. And this kind of expectation from the Fed was a very dovish one in comparison to what we had previously been hearing from the Fed. Yet over the past month, 2 months, 3 months, we have started to see a kind of emergence really of some more worrying data over inflation, some stronger inflation data, some data which is showing that maybe the labour market is tighter than previously expected, that there still are a great deal of price pressures within the US economy, especially on the service sector side, and ultimately, with regional issues elsewhere in the globe and issues to do with, the supply of certain natural resources, there are still a great deal of inflation risks to the US economy, which might hinder Jerome Powell or the rest of the Federal Reserve being able to lower interest rates, whilst making sure that they're keeping inflation low. So that's kind of been the key issue, and that's kind of what related to yesterday's market briefing. And what we're seemingly hearing from Jerome Powell here is kind of reiterating what we were expecting, which is basically that the Fed isn't able to cut interest rates as early as previously expected by investors or traders, until, of course, the Fed sees that inflation figure, the inflation data, resembling what, of course, the Fed sees as their inflation target, that being that 2% nominal figure. So that's why this is so important to highlight, as ultimately, if we then don't start to see that key inflation data, representing inflation coming down to that 2% figure, rates could stay as high as they currently are for as long as they need to, really, until we see that data, which of course is a very hawkish message from the Fed, especially monetary policy wise, and that's definitely going to be influencing and making an impact on markets, which of course we'll cover in a bit on the chart, so make sure you stay around so you see that. But ultimately, this is very, very important to hear. And the key thing is, though, that this shouldn't be a surprise. Ultimately, we've heard time and time again from Jerome Powell, even if we go back to September of last year, the Jackson Hole meeting and that kind of thing. We were hearing just back then the same that we're hearing now, that the Fed want to hear, strong. Well, not here, sorry, but they want to see, a list of data points which are basically showing that inflation is moving to that 2% target, and they want that strong confidence across the Fed to basically then make that move. They want the data, they want the evidence, and they're not going to make a move until they do such. And Jerome Powell has repeatedly said that ultimately they need to wait and wait and wait until they see the correct data before making a decision. They can't just jump onto a rate cut before inflation's neared its target, and then as a result create a great deal of inflation as a result of making that decision. So it's a very important article to highlight here, but one that really shouldn't surprise you if you've been following the Fed's rhetoric for some time. Despite this rhetoric, we could still definitely be expecting the 3 rate cuts which the Fed has said that they will do this year, and that's largely because ultimately all this rhetoric really does is it pushes back the date that we're then expecting those interest rate cuts. It's not a matter of will they actually cut interest rates ever. They of course it's almost 99% that they would do that. Ultimately the question is, of course, when they start those rate cuts. And of course, as I've highlighted before, investors have expected the rate cuts to be as early as March. We know that that's not the case. As early as April, as early as May, and as early as June. And that was the kind of very recent expectation. But of course, following those recent inflation data figures and other figures in relation to employment and services and that kind of thing, the current expectations are around July, but that's still close to 50-50 what the swap markets are pricing in for an interest rate cut on that debt in that month. So definitely this is an interesting time for inflation and for the Federal Reserve, and an interesting battle which Jerome Powell and his team are having to fight, with this comment striking a more hawkish and cautious tone regarding monetary policy. Interestingly, prior to this speech where Powell commented on inflation, the Fed has reiterated that they still expected to cut interest rates by 0.75% this year. The recent change in Powell's rhetoric, however, comes as strong labour data from the labour market and signs of stubborn inflation have cast doubts on early rate cuts. Despite the recent data, however, Powell said that it has not materially changed the overall picture, with the recent data being too soon to represent anything more than just a bump. The key message Powell made throughout the speech was that the Fed saw it not appropriate to lower interest rates until there was stronger confidence that inflation was moving sustainably down to the 2% target inflation figure. The message and other comments also align with the views made by other Fed officials who have indicated on the whole that the Fed is in no rush to reduce interest rates. Powell also made it clear that the Fed was free to set its own monetary policy independent of any short-term political matters, and that the Fed was not made up of climate policy makers. This message comes as, of course, the 2024 presidential election rises on the horizon, where Trump versus Biden go head to head. So a very important article here, and a very important topic, of course, that we cover often, but an important one nonetheless to keep your eyes on and keep on your mind. That's all to talk about in this article, though. Next article to talk about is still on the topic of inflation, but more so in regards to gold. So more so now relating that rhetoric to the markets themselves, with gold, of course, being that key inflation hedge, which we always talk about and cover on the charts. Of course, we know that gold has been rising to recent all-time highs, and so, of course, this is a very important topic to talk about. Now, the price of gold has now reached an all-time high following hawkish Fed rhetoric. That's what we just spoke about. This comes as the Fed points out that stubborn inflation means that it may be hard for the Fed to cut interest rates as early as previously expected. Now, of course, I'm not going to regurgitate or reiterate what we've already just said, talking about the last article with Jerome Powell and his more hawkish rhetoric in regards to monetary policy, but I'm going to link back to the history of gold and what we've currently been talking about on gold when we've been on the charts during these morning market briefings. Now, ultimately, gold, of course, has been in a very interesting position coming out of kind of the period of lockdowns, and then the ensuing Russian invasion into Ukraine and the inflation era that we have now almost nearly exited. Of course, that's what we were just talking about on the last article, that the Fed is still fighting, but ultimately we are now kind of on the tail end of that era of high inflation, record inflation levels. And as a result of those higher levels of inflation, as a result of the instability during COVID, we of course saw gold rise to these all-time highs over and over again. And we saw the same, of course, following Russia's invasion into Ukraine. So these were three very key points for gold's price, which caused gold to rise to monumental levels. And now we're seeing gold's price break above those levels, break above those key three events price levels, and just continue pushing higher like there's nothing stopping it. Of course, we've highlighted a few times what's driving this, what could be driving this, what we still have this stubborn inflation, which the Fed is struggling to get rid of, as mentioned in the previous article. Not only that, but of course, conflicts rage around the world still. We've of course still got Russia invading Ukraine. That always has the possibility of escalating further. We never know what's going to go on with that. And we are currently seeing the kind of the level of lethal aid being sent to Ukraine is kind of increasing dramatically if we just look over the past year, 2-3 years. So that's something that's very important to also note. In addition to that, of course, we're having the property crisis in China, and then most recently, of course, we have Israel's war with Hamas, which is now on the verge of breaking into a regional war involving, of course, the likes of Hezbollah in Lebanon and Syria, Syria's government themselves, and even Iranian proxies in Iraq, and even possibly, of course, Iran themselves, after, of course, Israel suspectedly, of course, struck the Iranian consulate in Damascus, Syria. So definitely this is a very important asset at the moment, and one that's very high on the list of importance for investors as we are currently in this era of instability. So definitely this is a very important article to note. Now, with the price of gold rallying up 15% to reach $2,295 a troy ounce yesterday, not only that, not only has the Fed rhetoric pushed gold higher, but also the concerns over the possibility of a regional conflict in the Middle East has led traders to buy up gold. Therefore, stubborn inflation figures, multi-year world tension highs, and market crises in nations around the world has led the safe haven asset to rise to new all-time highs. With Johnny Treves, a gold analyst at UBS, saying that the expectation for falling interest rates remains an important driver for the bullish outlook on gold. Gold remains the key inflation hedge, and so investors purchase it for inflation protection. As well as that, another commodity which is of course very important to highlight, Brent crude oil, has now crept up nearly 18% from mid-February to nearly $90 a barrel. So commodities are going crazy, equities are going crazy, cryptocurrencies are going crazy, and we're all going to be covering that on the charts just next. But we've covered lots in the articles. Next to talk about, of course, is the charts, as I just hinted to, but of course we are starting on the US 30, a very important index to kind of highlight and talk about, as it is kind of highlighting the current health of the US equities market. Now, of course, the US equities have been very strong recently, especially over the past month or so, or multiple months recently, with certain Fed rhetoric and, certain data kind of playing into the way that the US 30 and other indices have been moving. Ultimately, though, starting off the new week, we have of course seen the price of the US 30 sell off dramatically. The Dow Jones has sold off, and we did highlight this kind of area at the bottom of this range as an area which price could interact with and then either range around or continue higher. That said, we actually saw price break below that level, which was a very key area, not only because price has previously reacted to it as an area of support, but ultimately because it's a strong area of previous resistance. So we were expecting a high level of buy orders to be within that area. Despite that, price overwhelmingly broke below it, broke through that with no kind of hesitation, it seems, and has now kind of hooked back on that area of price and is now reacting in a bearish manner, as you can see here. And that is kind of what we often refer to as a break, hook and go, where price breaks below an area of liquidity or breaks even above an area of liquidity, and then quickly hooks back on that area before then continuing on that move to the downside. Usually that's kind of in a process of the market kind of finding its price and gaining liquidity before a significant move to the downside. That said, the current candle that's being formed at the time of recording is of course one which is highlighting maybe that there is a great deal of buy orders still within the market, so you're going to have to review that for yourself at the time of your seeing. But ultimately, yeah, we're seeing this kind of bearish momentum enter the US 30s, enter the Dow Jones and other US equities, and arguably this is ultimately because we're now expecting the Fed to hold interest rates higher for longer than previously expected. And so what's that going to tell investors? Well, maybe we shouldn't have our money in the US equities market, which is highly dependent of course on interest rates, and then maybe put that into kind of different assets instead. So ultimately that's possibly why we're seeing this action. That said, of course, we do know that these larger US equity indexes, of course, are largely more independent from interest rates, largely because, of course, they have those larger cash reserves, and so they don't require as much on kind of debt and lending and that kind of thing. So definitely, this is a very important asset to keep your eyes on, and some very interesting moves being made. Next to talk about though is the dollar. The dollar has sold off massively, quite surprisingly actually, of course, when we consider the rhetoric from the Fed. Arguably that's also just because the Fed is saying that inflation's high, but one would still expect that if the Fed is kind of reiterating that interest rates may have to stay higher for longer, you would expect the dollar to stay higher. We're not seeing that though, and instead, price is selling off. Maybe that's because the market was pricing in kind of the Fed introducing kind of interest rate hike. That's very unlikely though, but maybe they were expecting even more hawkish rhetoric from Jerome Powell. But ultimately, I think the largest reason is actually more of a technical reason on the part of where price came up to and then sold off from. This was an area which we had highlighted a long time ago and said that it was a very key area. It's around the 105 area on the dollar, and it's an area which made a significant low for the dollar, and then acted as a significant area of resistance previously for the dollar as well, before of course the dollar then ran off to the downside, and now we're on that that upswing once again for the dollar. So definitely this is a very key area for price, and the question will be, of course, over the next month or so, whether price will then be able to break above that should the Fed kind of maintain this more hawkish rhetoric that we've been hearing recently. So definitely keep your eyes on the dollar. Next to talk about is Euro USD, so still on top of the dollar, where we're also seeing this kind of shooting up to the we're seeing this kind of bullish momentum once again enter the Euro USD market. That said, price is now, of course, interacting with that 78.60 Fibonacci retracement level. So the question is now whether price will then sell off from that area and then continue to the downside, or in fact, will we see price kind of continue higher, break above that area of liquidity and Fibonacci level, and then continue a move to the upside. Very important to keep your eyes on. Some very volatile moves though, to be said, about what's happening on the Euro USD. So definitely keep your eyes on the euro. Next to talk about is pound yen. Obviously pound yen's kind of been consolidating recently, but after coming into contact with that 61.80 that we highlighted in yesterday's morning market briefing, price is now overwhelmingly surged to the upside. I did highlight in yesterday's market briefing how price had interacted with that level, so one would expect that kind of bullish momentum to enter the market. However, we're kind of seeing these weak candles. That could be explained by the fact that when I was recording it, we were neither in the pound session nor the yen session, market times and market session times and that kind of thing. And it seems like starting off the yen session last night, price was able to push to the upside, and we've seen now pound surged even further to the upside during the morning of the pound, morning of the UK, and that kind of thing. So, strong bullish momentum now entering the pound after coming into contact with the 61.80. So definitely keep your eyes on pound yen. Next to talk about though is Bitcoin. Of course, a very interesting asset to be looking at the moment. Price has made its way down to this 61.80 after struggling around the 78.60 level up there. Price has reacted in a bullish manner from that area. That said, we're not seeing an overwhelming amount of bullish momentum to the upside, so possibly this could be hinting to a further move to the downside, a further drop. We definitely have the 78.60 on the cards. If this is, quite possibly a kind of attempt in the markets to kind of take out that liquidity, take out those stop orders, and then have that continue to surge to the upside. Because as we've previously mentioned, there's a lack of liquidity within the Bitcoin market, and so when these moves are going to be made, liquidity is going to have to be found somewhere. So definitely keep your eyes on Bitcoin. Gold, of course, is very important to talk about, as we did highlight it in that second article. And as you can see here, just to contextualize it, price is continuing to push higher and has now broken above this minus 27.2% Fibonacci retracement level, which we did highlight as an area which we were expecting price to react from in a bearish manner. Price has had a short bearish reaction from that level and has just now continued to push higher with a great deal of bullish momentum still within the market. So definitely keep your eyes on gold. Next to talk about though is oil, which is now currently above that $90 a barrel $90 a barrel mark, which is very, very significant for oil, and of course not seen since October of last year. So significant moves on oil at the moment, as of course regional tensions and worries about a regional conflict within the Middle East is pushing oil higher. So definitely keep your eyes on oil. That's all to talk about in the charts though. Lastly to talk about, of course, is the economic calendar, where we're getting a great deal of data today. Now, firstly, we are getting the Swiss inflation rate figure, followed by the Eurozone, British, German, French, Italian, and Spanish services figure. So lots of services figures from Europe today. Quickly to run through though, we are getting the ECB monetary policy meeting accounts, as well as that we're getting Canadian balance of trade figure, as well as the US balance of trade figure, followed by that US jobless claims figure, and finally numerous Fed officials are doing their speeches today as well. So lots to listen out for, lots to look out for. We've covered lots in the articles, lots in the charts, and lots in the economic calendar. Hope you have a great trading day, but that's all from us at Wildwood Capital. Have a great one. See you later. Bye.